Hello and welcome to another short tutorial from the Microlearning Institute. This short tutorial deals with the fundamental principles of IAS 37, provisions, contingent liabilities and contingent assets. Let's start by looking at what IAS 37 says about provisions. A provision is defined as a liability of uncertain timing or amount. We recognize a provision if there is a present obligation resulting in a probable outflow that is measurable with reliability. A present obligation can be either legal or constructive. A legal obligation arises due to the need to comply with the law, whereas a constructive obligation arises from a pattern of past events that create an expectation in the mind of a stakeholder. IAS 37 specifically states that we do not provide for expected future losses, the reason being that there is no present obligation to make future losses. IAS 37 states that in the case of an onerous contract, we provide for the unavoidable cost of the contract, and this unavoidable cost is the lower of the cost of fulfilling the contract and the penalties from failure to fulfill the contract. Next, we look at the measurement of provisions. And IAS 37 states that we review provisions at each reporting date and adjust them to reflect the current best estimate at that reporting date. If a provision is material, it should be discounted to present value, and the unwinding of any discount is charged to the P&L as a finance cost. If we wish to create a provision in relation to a large population of items, then we provide for the best estimate of the likely outflow, reflecting probability weighting of all the possible outcomes. In contrast, if there is only a single obligation, then we provide the best estimate is the most individual, most likely outcome. In relation to reimbursements, some or all of the expenditure needed to settle a provision may be expected to be recovered from a third party. This reimbursement should be recognized only when it is virtually certain that it will be received if the entity settles the obligation. The reimbursement should be treated as a separate asset, and the amount recognized should not be greater than the provision it applies to. The provision and the reimbursement may be netted off in profit and loss. Next, we look at what IAS 37 says about contingent liabilities. A contingent liability is defined as a possible obligation or as a present obligation where outflow is not probable, or as a present obligation where the outflow cannot be measured reliably. A contingent liability should be disclosed. We disclose the nature of the contingent liability, its financial effects, any uncertainties, and the possibilities of reimbursement. Next, we review IAS 37 in relation to contingent assets. A contingent asset is a possible asset. An example might be a potential settlement from a lawsuit. IAS 37 advises the following treatment for contingent assets. If the inflow is virtually certain, then we recognize the asset. If the inflow is probable, then we disclose it. And if the inflow is not probable, then we do nothing. IAS 37 also provides guidance in relation to restructuring provisions. A restructuring is a program that is planned and controlled by management and materially changes either the scope of a business undertaken by an entity or the manner in which business is conducted by that entity. Examples of restructuring would include the sale or termination of a line of business, or the closure of a business location, or maybe changes in the management structure, or a fundamental reorganization of the nature and focus of the business. IAS 37 states that we provide for the direct expenditures of the restructuring if there is either a detailed formal plan or a valid expectation in the minds of the stakeholders. Direct expenditure in this case refers to the expenditures necessarily entailed by the restructuring, and not to expenditures associated with the ongoing activities of the business. A restructuring provision should exclude any retraining or relocating of continuing staff, any marketing expenses, any investments in new systems, or any investment in subsequent distribution networks. Thank you for watching this short tutorial on IAS 37.